April 2018, so it will be interesting to hear her perspective. We have Charles Yates. He is a specialist in renewable energy with a passion for delivering projects which are commercial and serve the public good. He has been associated with arranging huge funds, financial closure for an offshore wind project of $265 million recently. Then we have Michael Veldron. He is an energy investment analyst. He is economist from International Energy Agency. So we will have an economist view as well. We have Mr. Ajit Agrawal, Director of Finance, REC. He is one of the largest financial institutions in India. Then we have Mr. C. Gangopadhyay, Director of Projects, Power Finance Corporation. I think these two need no introduction. We have Mr. Rohit Khanna. He is manager for the World Bank Energy Sector Management Assistance Program and Energy Climate Finance Operation. He joined World Bank in 2000, and he has worked with Climate Technology Fund and Global Environment Facility. Then we have Mr. Pawan Agrawal, Senior President, Yes Bank. He has almost 18 years of experience as a banker. I have not left anyone, I think. Okay, I have spoken. So with this introduction, I leave it to Mrs. Arundhati Bhattacharya to take the session forward. We have in financing today, the perspective keeps changing. We started with the tariffs when tariffs were 15 rupees. The perspective of bankers, developers were different. Today, when the tariffs have come down to 2 rupees 44 paisa, the perspective might be different. The perspective keeps changing as the prices keep coming down. That is one part. The perspective for wind, for offshore wind, that have been changing quite rapidly over the years. So it will be very, very interesting to see how other bankers and financial institutions, international organizations think about it. Thank you.
Thank you, Mr. Popley. Good morning, everybody, and thank you, Mr. Popley. We have a pretty large panel, as you see, but the topic obviously is equally large. And I think the ministry has put together a very diverse panel in the sense that we have a foreign banker, we have an Indian banker, we have the PFC and REC, which finances the biggest power sector projects in India. We have an economist, we have people from multilateral agencies, both KFW, known for its exposure to renewables, as well as the World Bank. And of course, you know, we were supposed to have somebody from the developer side. I think we are missing only that. But anyway, I'm sure there'd be more people over here who would be from that side. So the way we will run this session is we will have about an hour's discussion from the panelists, and then we'll have 15 minutes at the end for questions from the audience. So, you know, in respect of the renewable sector, as you know, India has made substantial progress in renewable energy over the last 5 years. And this has been driven by large resource potential, strong regulatory push, and tariffs below grid parity. So today it is amongst the top 5 renewable countries in the world, with 22 gigawatts for solar, 34 gigawatts for wind, as at March 2018. And the targets that we are required to achieve is 225 gigawatts by 2022. So that seems like a huge target to achieve. Given the fact that this is our target, what we are looking for today is financing to the tune of $100 billion, with 75 billion coming from debt and 25 from equity. Or it could be greater equity if that is available, but still a pretty steep target. Now, that being the case, what I would like to do today first is request Mr. Gangopadhyay from PFC to lay out the challenges in front of the sector. I will then go on to some of the multilateral agencies to find what has been their experience of facing these challenges in various countries of the world. I'll then go on to the City Banker and then to the Yes Banker to tell us how the bankers have been tackling this issue abroad as well as in India, and then to the economist to tell us how he perceives this really panning out. And we will round it out, I think, with the REC person telling us as to whether some of the answers have been received and what more they would like answered by the panelists. So with that, I would request Mr. Gangapadhyay, the Director Projects of PFC, to very quickly lay out in a few minutes, please, regarding the challenges that you are seeing in the sector, as well as, you know, the potential that this sector has.
Right. Thank you, madam, and a very warm welcome, and a good morning to all of you. I must thank ISA to begin with, to give me this opportunity to share our experiences and the challenges in this financing of the renewables. If we just go back by a couple of years, let's say about 2016-17, many things happened, and we are still kind of recovering from the trauma of the stress assets. We have not recovered as yet. But in 2016-17, something happened which has not happened earlier. That was that installation of the renewables outpaced the installation of other forms of energy. So thermal was outpaced. Thermal was defeated. So as a NBFC in the power sector, we have been habituated in dealing with large thermal projects, large hydro projects, and a little bit of renewable projects in the form of biomass, etc. But what has happened now is an entire shift of paradigm. Now we have been looking at the renewable projects and the solar projects in particular, which are really the way to go forward. Now, in doing so, there are challenges that we have faced, because again our growth in the renewable segment in the last 1 or 2 years has been tremendous. We sanctioned about 250% more in terms of renewables in 2017-18, compared to 2016-17, and in the coming years, perhaps the rate will go up further. So therefore, it's growing at a very furious rate. And whenever something grows at a furious rate, we generally have reasons to worry, reasons to calm it down and bring it down to a manageable pace. So therefore, in the renewable segment also, we are trying to stabilize, and we are looking at projects from the angle of their viability and from the angle of their long-term viability, in fact. In fact, some of the challenges that have come to us is that we had to bring out the policies for dealing with renewables. We had the policies for dealing with various kinds of projects. Now we said that, look, for renewables, all those policies will not apply, because one is that the gestation period is very small, less than a year, and they all have generally PPAs, which are upfront signed PPAs, and therefore all these projects will be viable only if they get a pricing which is affordable, and also many of them will be looking for exit in a few years' time. So therefore, what happens is that for all these projects, our existing policies of prepayment penalty, etc., they also work as a barrier. So therefore, we have brought about changes in those policies. What we have done is we have linked those projects to the market rating that they can get. We have also introduced the co-obligor structure, because there are small projects. There are 50 megawatt projects, there are 100 megawatt projects, and particular developer has got a large number of such projects. So therefore, to get a comfort, we have introduced the co-obligor structure. Now what we have found is that in the renewable segment, since the installation time is not much, and also the amount of investment, because the size of the project is 50 megawatt, 100 megawatt, or even smaller. So the entry barriers are very little. So various players are entering into this segment, and also the consolidation, acquisition, merger, etc. are happening. So therefore, ultimately in the field, perhaps you will only have a few players who are really able to take it forward.
Okay. So, Mr. Gangapadhyay, what I think you underlined is the fact that, the difficulty of assessing viability over a very extended period of time, which is what these PPAs are for or these projects are for, and the fact that entry barriers are low, plus there could be a lot of movement in the actual promoters themselves through mergers, acquisitions, sellouts, etc., etc.
Yeah.
So
But I will also mention one or two appraisal-related issues.
Yes, but very quickly, because we have a large number of people on the panel.
One or two appraisal-related issues. One is about the, quality of the solar panels, because in most of the cases, and more often than not, it's imported solar panels. And there has been an issue about the quality of the solar panels, and we have been raising this. We don't have any ready-made kind of a benchmark available in this country for assessing the quality, and therefore sometimes we go by the Bloomberg list. We insist for the tier 1. There are problems associated with that, because the tier 1, a supplier who is tier 1 today, the next year falls away from the tier 1, and therefore there are issues in that. So we are trying to resolve that. The other issues that we are facing is about in terms of the security built up in the project, the mortgage, etc. The implementation period is so small that the project achieves commissioning, and the mortgage of the land is not yet done. So that kind of scenario, these were not there in the thermal project, because the gestation period itself was 4 years. So therefore the land mortgage would have been done. But here that kind of issue comes into play. So we are trying to resolve these issues.
Okay. So I think these are two very prominent issues. Of course, regarding the mortgage, I don't think our international representatives will be able to say much. That's an issue we need to resolve ourselves. But on the solar panels piece, I think definitely the delegates here may be able to opine. So I'll go next to Ms. Carolyn Gassner. She's Director, South Asia, KfW Development Bank. As you know, Germany has done an exemplary job in implementation of renewable energy. And Carolyn, we'd definitely like to hear from you as to how KfW has negotiated these difficulties as they have gone about financing the renewable sector.
Can you hear me? Yes? All right. So first of all, also welcome from my side, and thanks very much for inviting me for this panel. Yes, I think in Germany, the situation in Germany, of course, was a bit different from the situation we see today in India, and which we heard right now, because when Germany started to develop renewable energy, the renewable energy sector, the pricing was not competitive yet for the renewable energy in terms of conventional energies. So what made, I would say, the development of the sector a success story was mainly a very good regulatory environment and a good incentive structure, which was mainly feed-in tariffs with compulsory connection also of renewable energy and purchase of renewable energy. And this made that the sector developed rather quickly. Today we are at an installed capacity of 100 gigawatt of renewable energy, of which around 40 gigawatt is in solar PV and 60 gigawatt in wind, onshore and offshore. And so I would say at that time and in Germany, the prices are not as competitive yet as they are in India. So we do not have this competitive, this strong competition, which might also lead to problems. KfW itself, I mean, apart from the regulatory environment, we have combined it with financing instruments, mainly also through KfW. KfW has financed around 50% or co-financed around 50% of all installed capacity in Germany. And what is the success factor? I think it's the wholesale business model of KfW, who partners up with the private banks. So we always work together with our private commercial bank partners. And we also have standardized loan programs for renewable energy. So it's very standardized, easy, including fast approval processes. And this has really made the development very quick.
Okay, so Carolyn, what you have really stated is that in Germany, the tariff structure was not as competitive as it is in India. So to some extent, that helped developers because they didn't have to quote such competitive bids. And the second thing that you've said is that basically there were a lot of incentives in the system for the renewable power producers. I think those are the 2 points that you made.
Exactly.
Okay.
Yeah, exactly.
Okay.
I mean, there's a strong support because the feed-in tariffs, of course, were higher than the conventional energy.
Okay.
And this, of course, came to the expense of a higher cost for the consumer because, of course, there was a levy, or there is still a levy on the tariff for renewable energy for the private consumer.
Right.
And yeah, of course, this means higher tariffs for the consumer, but at the same time is an incentive for the consumer to save energy and go into energy efficient equipment and so on. So I mean, it has also this effect.
So I think, you know, the incentives and basically what was worked out by in Germany is that while consumers paid, however, their awareness regarding the need to bring in renewables probably didn't make it an unpopular decision, even though the consumers paid for it. Okay, but if I can now go to Mr. Khanna, who's the program manager of the Energy Sector Management Assistance Program of the World Bank. Mr. Khanna, what we would like you to address is the issue that Mr. Gangopadhyay brought about regarding how do we assess the solar panel producers to see that if you go by the Bloomberg list, they're in tier 1 and then they fall off. And these are all long-term projects where the manufacturers need to stand by their guarantees. And if they're not around to stand by for 20, 25 years, what is the way that we can sort of assess these projects and be sure that we are getting the stuff from the right people and that we are putting our money in the right place? So that and any other observations that you might have from your experience with other countries, please.
Thank you very much. Yeah, I mean, before I go to that, maybe just talk a little bit about how we see globally the trends on renewable energy, especially from the policy and regulatory perspective, because I think from where we see it, really that is the driver. In a couple of months from now, we will put out a report that will summarize how countries are doing with respect to their policy and regulatory environment for sustainable energy, using something called the RISE Index, Regulatory Indicators for Sustainable Energy. And so maybe I'll just give a quick preview of what we see as the direction of travel. The good news is that what we are seeing is that more and more countries are scoring quite high on their renewable energy policies and regulations. 7 years ago, only one country scored in the top group. That was Germany. And now in 2017, from 2017 data, we see that that number has gone up to 25. And countries at the bottom, that number has declined from 92 to 34. So we're seeing a lot of countries really adopting policies and regulations that favor renewables. Of course, it is true that the implementation policies are lagging behind a little bit. It's improving, that gap is improving, but it's still lagging behind. Just as an example, 92% of countries have renewable energy targets. 80% of countries have renewable energy action plans. but only 68% have regulations that allow small producers to connect to the grid. So there is quite a bit of work still ahead in terms of implementation regulation. The other thing we are seeing is that we are seeing improvements in areas such as really having regulations related to forecasting renewables, grid flexibility, all critical enabling policies are improving. The other really positive development, I would say, is that the counterparty risk is improving. More and more projects are becoming bankable. It was interesting that only 25% of countries in 2010 had bankable PPAs. That number has gone from 25 to over 50% last year. Similarly, in terms of the availability of payment risk mitigation, those numbers have gone up from about 13% in 2010 to 31% in 2017. So across the board, we are seeing really a lot of progress on renewables. The one interesting development, which I don't know to what extent people here are that concerned about, is the fact that renewables for electricity gets a lot of attention, but renewables for transport, for heating, for industry, for cooling is really lagging behind. And as you know, actually most of the energy use is actually outside of the electricity sector. So that's an area where, as a community, we're going to have to do more. I think that just looking at what we see from the bank as critical for the ecosystem for renewable energy investment are really sort of 5 areas. The first and foremost is the enabling environment. I think we see still too many countries that don't really conduct a rigorous resource assessment. They do not have sort of least cost planning done. And so the location and sizing of solar facilities, there are too many, are really not optimized. And the creditworthiness of the utility remains for us at the World Bank really probably the biggest concern. The second area where we are really putting a lot of emphasis at the World Bank is on grid integration. It is absolutely essential that countries really have the grid codes, the dispatch and system operations necessary for greater integration of renewables. I think that it's especially challenging in not so much here in India, but in many African countries with small systems, with very limited spinning reserves. There's a real risk of adding, when you add more renewables to the system, what will happen to the reliability and stability of the grid. Third is on efficient procurement. And we've seen that, just as an example here in India with Reva in Madhya Pradesh, solar parks, the solar parks approach with auctions through the plug-and-play model has worked well, and we are certainly encouraging more of that approach. And that sort of leads us to the fourth and fifth, which is on the financing side. One needs to have really robust risk mitigation. After you've had a good, thorough discussion on sort of bankable risk allocation, we must ensure that everything from macroeconomic to project-specific risks should be addressed. And the last point really is to make sure that we have a package of financing. We have found that providing grants combined with loans, concessional financing, as you know, the SBI program that we have on rooftop PV was really made possible with the concessional financing that we got from the Clean Technology Fund. It brought down the project financing costs and has really unlocked the market. From our perspective, to really make progress, we have found that having dedicated programs on renewables at the World Bank really makes a big difference. And we've done that with geothermal, we've done that with off-grid solar, we've done the utility scale solar, something called scaling solar with the IFC, and we are now moving on to a couple of new areas. Offshore wind is going to be something that's going to get a lot of focus at the World Bank. And then maybe you have heard that last week the President of the World Bank announced a major effort to accelerate the deployment of battery storage. And we feel that, that if we don't crack that nut, that we are going to run into a brick wall with renewables. And so the World Bank has put forward $1 billion program to finance battery storage, both to bring down the costs bring down the costs of battery storage that we have today, but also to demonstrate new technologies that are better adapted to the power sector. I can go on in more detail about sort of how we have designed these programs, but I'll stop here for now.
Thank you, Mr. Khanna. It's great that you bring us some good news in the fact that the bankability of many of these projects is showing a rising trend. We look forward to the World Bank report. I'm sure it'll have many pointers to the macro issues that countries are facing, and hopefully we'll be able to resolve many of the micro issues that we have through the inputs in the report. You mentioned about offshore wind, and we have an expert over here, Mr. Yates, the Managing Director of CMY Consultants, who said that he is an expert on offshore wind. And yes, that's an area that's attracting a lot of attention. So, Mr. Yates, if I could ask for your remarks, please.
Thank you very much, Madam Speaker. And first, let me say it's great to be here. And I'm really very pleased at such a big audience and so much attention. That's great to see. My involvement with offshore wind in India is long-standing. I've been working with MNRE for 4 years, advising them on their policy. So now that there are 2 projects that are in the pipeline, a lot of interest from international bidders, I'm really looking forward to seeing that driving through to a successful conclusion. But what I think is hopefully going to be very interesting is to talk a little bit about the success that Taiwan has had with bringing in international finance for offshore wind, which has allowed it to really drive down the interest rate costs and also to lengthen the terms of the debt, which make the prices for offshore wind much lower and help a great deal with affordability. I think Taiwan is a particularly relevant example for India because there are a number of important similarities. Taiwan, as you know, is a middle-income country. It's just embarking on its offshore wind program. It's got ambitious targets, 5.5 gigawatts installed and operating by 2025. And a few months ago, they raised the first international financing for Formosa 1, which is their first big project. And it's an international collaboration. The project is 120 megawatts. They raised $626 million US, and that was done by a coalition of local banks and international banks, also with an important element of support from financial institutions. And I think all 3 elements played a key role in the success of that financing. So the local banks understand the local regulation, the local politics, and they can help international banks get comfortable with that and work within that framework. The international banks have a lot of experience analysing the projects, understanding what the risks are, and helping to drive those risks out of the project, to minimise them, to mitigate wherever possible, and to allocate them appropriately, which brings down the project risk, which everyone benefits from. And also in this case, it was the Danish Export Finance Bank, EKF, provided some insurance cover, which again was an important part of the risk mitigation strategy, which has worked very well for that project. What was the result of that? Well, they were able to raise finance at 6 to 7%, so an attractive interest rate, and also the loan is for 16 years. And the other point that I'd like to stress is this has allowed access to a very deep international global pool of capital, which can meet all of the financing needs of Taiwan, and which in due course I think will meet the financing needs of offshore wind here in India. There were some interesting innovations in that project around the swaps, and I think financial hedging again is a key issue, certainly here in India. To bring in low-cost financing, you want to raise it in dollars, but that does raise some real challenges around hedging the rupee dollar risk, because the tariffs are going to be set in dollars, and indeed, sorry, the tariffs are going to be set in rupees, apologies, and rupees that are a constant tariff. There isn't even an inflation adjustment element, which can be quite helpful. So I think that there definitely are challenges, but I think the international banks are keen to get involved, and they can make a real contribution working alongside financial institutions and the Indian banks to bring in cheap, cost-effective capital.
So thank you, Mr. Yates, for sharing this experience in Taiwan for this very large financing that they have done. And they have managed to get it from both national and international financing organization at around 6-7%. I'm sure if the developers over here, they must be really, looking at such structures, because obviously in India, we can't expect anything below 9%, I think, at this point of time. And that's probably the floor that I'm talking about. And again, the challenge, of course, in India, as you rightly said, is the fact that if we get dollar financing, how do we hedge it? And this is over a very long period of time. So that's something that we still have to solve for. But I think what we need to do is to study these various types of financing and these deep pools of capital that are available, to see how our Indian developers can also tap into these ways of financing and come up with innovative structures. But before I go on to the two practicing bankers, I would like to request Mr. Michael Waldron. He's from the energy investment, he's an energy investment analyst from the International Energy Agency, to give you his overview as to how he sees the sector, and thereafter I'll go on to the practicing bankers. Yes, please.
Thank you very much, and thanks for having the International Energy Agency on the panel. For those of you not familiar with the work of the International Energy Agency, we advise governments and decision makers around the world on policies to realize their energy goals. So what I'd like to do is very succinctly give you some messages and some insights from two different reports, one that the IEA has produced and another the IEA has produced with an Indian partner, Council on Energy, Environment and Water. One of these reports is our World Energy Investment Report, which was released in July, and this is available for free on the IEA webpage. What we do is we track every year the annual investment flows in the energy system, and one of the main messages we found this year is that the electricity sector continues to be the largest destination for investment, so electricity being larger than the oil and gas sector. Of course, this is very much underpinned by the robust investment that we've seen in renewables in recent years. Renewables were about $300 billion in 2017, which has remained relatively steady for the past 5 years. But also echoing the comment from the World Bank colleague, most of this is in electricity. So we're not seeing the same sort of progress in renewables and transport and heat, where the investment totals were only about $20 billion in 2017. So drilling down into some of the drivers and some of the policy frameworks around this, we find that about 95% of the investments in the electricity sector are dependent on some form of regulated pricing or contract. So governments, of course, have a very important role to play in terms of effectuating and motivating investments. And when we look at the investment challenge, we look at it from two different perspectives. So we'll look at it from the perspective of the investors, who often need adequate, stable, predictable returns in order to make their business case, but we also look at it from the perspective of the governments. So the governments want certain attributes around investments, and these have to do with the affordability of the electricity, the reliability, the system value, the ability to integrate the renewables. In many cases, these two, let's say, perspectives can be in tension, or there can be a trade-off of them, and it's a dynamic exercise. So to understand how this exercise proceeds over time, and investors and governments working together, is really a key for investment. So kind of putting a bit more meat on this, or drawing it out in a couple different points and cases. When we look at how renewables are being financed, we still see most financing being done on balance sheet of well-capitalized developers, but we also find that there's a growing role for project finance, and in particular a growing diversification of project finance around the world. Whereas 5 years ago, most project finance structures were concentrated in places like the US and Europe. Now we're seeing more project finance being used in emerging markets. We're also seeing a growing role for refinancing and the role of blended capital, although these are very difficult to track in order to put numbers on them and to understand how this is impacting the real investment case, but nevertheless we see them as important factors. When we look at some of the policy and regulatory frameworks supporting investment, we find that having stable long-term pricing on an IPP model is basically the predominant driver of renewables investment in many parts of the world. If you set aside China for one moment, because China has a very outsized influence on the numbers, we find that about 50% of investment in utility-scale renewables is now being determined by some sort of competitive mechanism for awarding remuneration, so through auctions and tenders, for example, which is becoming the dominant policy instrument being used worldwide. But the way these are structured in different markets has to do with the way societies and governments are in the renewable policy journey. So the policy priorities for a government who's just trying to attract those initial investments, such as some governments in Southeast Asia right now, versus those who are trying to scale up renewables, such as the case in India, or those trying to manage renewables at much higher shares to integrate them, such as the case in some Nordic countries, can be different. So, but what is kind of a commonality around all these things is principles around the level and the predictability of the price incentives, the degree of exposure to merchant price risk within the contract and the business model. So in places like India, you have very long 25-year contracts, but in other places in the world, such as Mexico, they've designed an auction system where the contracts are shorter, there's more exposure to merchant risk, and the business model is more complex because there's an interplay between the time and location value of the renewables in awarding the price. So governments are getting more creative in trying to design these types of structures to better integrate renewables at higher shares. The bankability of the PPAs, also echoing another comment from the World Bank colleague, has been important. We are also seeing good progress in this, although in some countries, in some places around the world, this still remains an issue for starting investment or for scaling up investment. And also the creditworthiness of the utility off-takers. We did an analysis this year where we looked at cost recovery ratios for utilities in different markets around the world and how this impacted credit or the off-taker risk, but also the investment in the grid. And then, of course, the capacity of the local banks and the ability to bring financial risk mitigation instruments are also important issues for investment. So just very succinctly, one case that we looked at this year is we looked at the development of the offshore wind sector in Europe and how this has been financed and invested in over time. And we found that in Europe, improved financing terms has had a very material impact on reducing the costs of offshore wind. So the reduction in debt financing costs alone has contributed about 15% to the reduction in the levelized cost of electricity. So this is an important factor in trying to scale up that technology. And what has been sort of the enabling factors behind this? Well, one is just the general low interest rate environment in Europe has been important, but also is this reduction in debt risk premiums that we've seen over time. And this has occurred because a number of government and private sector actions which have helped to sort of create the ecosystem for offshore wind, having long-term targets, governments starting off with feed-in tariffs, but then shifting gradually to auction systems as the technology and has developed and business models have become more mature. Having this stable policy framework which gives visibility over the remuneration has also enabled the supply chain to develop around this. So in many ways, governments just need to set the initial conditions and get them right for investors, and the investors and the manufacturing and the industry will come in later on. Where governments have been very instrumental in helping offshore wind in Europe is also in providing regulatory support for the infrastructure. So providing, in some cases, the grid connections or the grid infrastructure, which has been important for enabling the business case. And we also see the involvement in the utilities in the offshore wind sector and the public financial institutions. So various development banks have been instrumental in helping offshore wind go down that learning curve in Europe. So to sum up, a variety of industry and government factors which have contributed to that technology's development, which I think can be an interesting case study for India to look at. So I will conclude with just a couple points on what we observe in India. So we've done some analysis. We have a collaboration with Council on Energy, Environment and Water, and so this is the second report I'll show you that we produced with them earlier this year to look at clean energy investment financing trends in the Indian context and try to extract lessons and objectives for policymakers. So in 2017, what we saw in India was for the first time that renewable investment was actually larger than that for thermal power. So this is actually quite sort of a momentous shift in the way the capital is being allocated in the Indian sector. But if you look at what's needed under long-term IEA scenarios, renewable investment is still falls short of what's needed to meet long-term energy goals. And in the analysis we did with our counterparts at CEW, we looked at some of the industry drivers behind the final investment decisions being taken. And we did a number of stakeholder interviews and also looked at data around solar and wind in terms of a project database. And what we found is that access to favorable finance has been really key to effectuating investment decisions, and that increasingly well-established industry players and those with access to foreign capital are playing a role in terms of dominating the FIDs. We find that on an annual basis, when we look at the tenders, foreign final investment decisions are being increasingly concentrated among a smaller amount of players. So there's a degree of market consolidation and market concentration occurring, which is helping to bring scale and helping to bring better financing terms, but also that these players are changing every year. So there's still a, say, relatively open competitive landscape for competition among developers. Government involvement has been, of course, instrumental in setting the targets, the terms of the auctions to give visibility, but also in terms of helping developers to manage land and infrastructure risks. So we cite the solar park scheme as being very important. The solar park scheme has been particularly important for attracting foreign independent power producers, and in fact, it's foreign IPPs who are the largest segment taking advantage of the solar park scheme. And then the last point I would make is the investment decisions still very much depend on the creditworthiness of the off-taker. We looked at the projects being built and which off-takers they correspond to, and the majority of projects being originated in the past few years have gone more towards the central off-takers as well as the state off-takers with good credit or good utility performance, and relatively less to those with weaker financial performance. The last point I would make before turning it over to the chair is that it's really important from our perspective and from government's perspective to have better data on financing trends and investment trends. This is not always a sector that's very transparent from our perspective. So being able to make better data available on how these projects are being financed and the trends over time can be very instructive for government policymakers in setting the right policies to motivate investment.
So thank you for sharing the results of the survey on India. Of course, you are correct that the government initiatives regarding things like solar parks has definitely been instrumental in the huge growth that we have seen in solar power in the country. And it's thanks to people like Mr. Popley who have spearheaded this from the government side that these things have happened. I fully agree with your conclusions regarding access to financing as well as the health of the off-takers. I think those are areas of very large concern, and I'm sure the government is looking at it, and it's definitely instrumental in how we do things going ahead. Having said that, I'll now turn to Mr. Michael Eckhart. He is the Managing Director and Global Head of Environmental Finance and Sustainability at Citibank. And Citi has had a lot of experience and exposure in various countries in the area of renewable energy. And he brings to the table a lot of experience about what they have seen in various countries. And we'd love to hear his observations as to how things can be made better in India, especially access to financing, which is so key to the growth of renewable energy in India.
Thank you, and thank you for having me. It's a pleasure to be here, and thank you, Mr. Popley, for arranging that and the invitation. It is a pleasure to be here. I've been in solar PV and renewable energy for 42 years, since 1976, since it was zero. And so even though we have issues and problems today, it's wonderful to have these issues. It's like owing too much tax. It's a problem everybody would wish to have. And we have a tremendous success going on with clean energy around the world. Yes, I work at Citigroup, the parent company of Citibank India, and I've been coming to India myself since 1996, and I think this is trip number 30. And I've worked with IRETA all this time, even Mr. Popley and his predecessors, Mr. Majumdar and Mr. Bhaktavasalam. It took me a year to be able to say that. So it's a pleasure working here in India all these years. So with that perspective, and then Citibank India, as you know, is a large bank itself. It's a retail bank, it's a credit cards bank, and it's a big corporate and investment industrial bank. And that's the nature of our work here. And so we're keenly interested in the clean energy space. I want to congratulate India on we don't even realize how brilliant India has been in these last 3 years, adopting rapid changes in policy to create these markets. And everything I would suggest that government does should be in some way related to attracting and supporting the supply of long-term, low-cost debt capital to these projects. Lacking this capital, the projects don't get built. So then what attracts this capital? And it's been mentioned already, the creditworthiness of the entire situation. But what we have today is a confusion in the market, not just in India, but around the world, because two different industries use the term project financing, but they're very different. The World Bank and the MDBs do project financing in a certain way. Then the IPP industry, which was born in the US, as you know, uses the term project financing, but quite different. It's not based on political strength around a project through governments. It's based on the merit of creditworthiness of the participants, especially, as Mr. Walden said, the offtake utility. So what have we done in the US and Europe to make the great success that we've had? We gave offtake guarantees to the developers. This is not understood by everybody that this is what happened, and this was the key. This was the silver bullet. In the United States in 1978, we passed a law called PURPA, Public Utility Regulatory Policies Act, which was a guarantee of 20 years revenues at a set price for all alternative energy and cogeneration. 20 years later in 1998, and I was pleased to be in Germany to participate in this and drafting and developing the feed-in tariff. What is the feed-in tariff? It is a 20-year guarantee of revenues at a set price. If you generate the electricity, you will be paid. So the success we created for ourselves to attract long-term low-cost debt capital, call it 15-year loans, in both the US and Europe was to provide offtake guarantees. My proposition from Citi, looking at financing, why don't we do for the rest of the world what we did for ourselves? It's the answer to getting long-term low-cost debt capital is to have very high confidence that the revenues will be paid so that the project can pay its debt service on those loans. We need two types of capital, short-term capital that can provide from banks for the construction, and then we need access to the capital markets, the debt capital market, the bond market, for the long-term capital over the life of the project, because banks no longer lend for 20 years anymore. They can't. Those are the new rules. So we have to get, and I would say, after 40 years working on this, We reached the debt capital market in the year 2013. We really did. And it's been optimization since then, the past 5 years. And India needs to move to this. Now, on creditworthiness, there's two levels. One is the creditworthiness of the offtake utility, the DISCOM. On that, we, Citi, recommended to Minister Goyal to go to Prime Minister Modi to create a rupee bond market to refinance the DISCOMs and to use all that capital raised in a rupee bond market to pay down their bank debts, which had reached $75 billion US equivalent. And the program is called UDAY. It's pretty much complete now, and over $36 billion US equivalent in rupees has been refinanced in your DISCOMs in a rupee bond market, and the banks have received $36 billion equivalent, again in rupees, to use to finance the solar projects. So that massive rotation of capital that India has accomplished, many people don't know about this. It wasn't promoted. It was behind the scenes. This has created the added creditworthiness that is allowing India to succeed where it is right now. As Mr. Walter mentioned, there's a second way to do it, which is to provide a creditworthy alternative offtake to the DISCOMs, and you've done that with the Solar Energy Corporation of India and NTPC. And third, there's the issue of the guarantees. Back to the guarantees again, and you haven't quite moved to the guarantees, but there is a movement around the world, which I'm recommending, that the World Bank or the UN create a clean energy offtake guarantee agency, not for loan guarantees, but for the offtake revenue guarantee. That, in effect, would be the guarantee I mentioned that we did in Europe and the United States. Do it for all countries in the world. Lift clean energy above all the issues that affect all the economies in the world. And the issue number two is the creditworthiness of the projects themselves. And I have a problem with where things are going. Because this has gone from OECD utilities being the offtakes to government-owned utilities in the developing countries, the procurements are now done under government procurement rules, which the basic rule in government procurement everywhere in the world is low price wins. Picking your next power plant based on who will bid whatever price, we want to rethink that. So in Argentina and Mexico and Turkey and everywhere else, as well as India, I am recommending, and I wish to put forward in this conference, the idea that these procurements have two numbers, not one, not just cents per kilowatt hour. The second number is called a debt service coverage ratio. It's a measure of how financially viable is the project at that price. So if you have a bid of 2.5 cents per kilowatt hour with a ratio of 1.0, it only provides enough money in the best case to make debt service. Would you pick that one? Or would you pick one at 3 cents with a service coverage ratio of 1.5? Oh, this one's financially viable. This is telling you that low price may be failing in the future. And what I fear is that what we're creating at this time with all these low price bid procurements is 5-10 years from now we will have a wave of project bankruptcies and refinancings because things go wrong. As mentioned on quality, if you have a quality issue, and certainly there are quality issues, that means the projects will not generate the kilowatt hours you thought, which means they won't have the revenue you thought, which means you will fail to make your debt payments and you will have to declare bankruptcy. You see how all this flows? Yes. So we want to do on quality. We want to have assured revenues. We want to have creditworthy offtakes. And I want to congratulate India for taking steps like no other country I've seen on all these fronts, which is you have created your own success. So with that, mentioning that the UDAY program of refinancing the utilities, this is a model for the rest of the world. Creating your alternative procurement or offtakes, this is a model for the rest of the world. So I put forward the guarantee concept and also the second number on the bids so that the financial viability of the bids is known. With that, I want to congratulate India for the steps taken. I really think India is becoming a model for the world. I've recommended that to the ISA to create a case study and educate the rest of the countries in the world as to what India has done. So thank you very much for having me.
Thank you, Mr. Eckhart, for that, for the very different kind of suggestions that you came across. Maybe if we have a chance of going back to World Bank, I'll check with them regarding what they think about the Clean Energy Offtake Guarantee Agency. That seems to be a really interesting concept. But I found this other concept that you gave, that at the time of auction, you should be asked not only for the tariff, but you should also be asked for the DSCR, that's the debt service coverage ratio that the tariff creates, because that would immediately show the bankability of the project and would definitely enable very quick financial closure. So that seems to be a really differentiated idea. I do not know whether, Mr. Popley, you can follow that up and create something. I'll come back to you for the last words after I finish with the rest, but you can think about it in the meanwhile. And then I will ask Mr. Pavan Kumar Agarwal. He's the Global Head Renewable Energy at Yes Bank. Yes Bank has been very bullish on the renewable energy financing front. So I would like to ask him what he thinks of these proposals and what indeed Yes Bank has been doing in order to finance renewables.
Thank you, Anadati, and I'm thankful to the organizers for having Yes Bank on the panel. Whenever you ask a banker on their perspective on any sector, it's generally loaded with a lot of risk and challenges, what all need to be done by different stakeholders to make it work, to make the entire investment risk-free. And that is obviously what a banker's job is, right? To mitigate the risk and make a project bankable. But I would like to slightly take a little different view and through the immense opportunity that we see this sector offers, not only for India, but for all the ISA member countries. So there is a very thin line between a hubris and a vision. And you can spot a visionary only in the hindsight. I remember I was very closely involved with RE Invest, with CII, with MNRE, with IREDA, with the government, as a private sector participant. And when Honorable Secretary came back with a meeting with our Honorable Prime Minister PM Modi, and he said that we have been given a target of 175 gigawatt, out of which 100 gigawatt is going to be from solar, it looked like a scandal. It was very, very difficult for for us to believe. We were nowhere near a situation where we can dream of 100 gigawatt by 2022. And then today, if you see, yes, it's not very far off, right? In 2014, we conceived RE Invest. 2015, January was the first RE Invest. Today, we are sitting in 2018. And now that target looks completely doable. Actually, in fact, it looks very less when we realize the potential. We're now talking about almost entire new capacity addition happening by way of renewable energy. We're talking about replacing our fossil fuel-based generating stations with renewable energy going forward. And if you look at it, the current contribution of renewable energy in the total electricity basket is what, in terms of almost around 2 to 3%, and close to 80-85% is something that is still being driven by fossil fuels, carbon-related generations. So there is an opportunity of 40 times the current scale that we're talking about that is just in front of us. And this is very well achievable. Now with the tariffs coming below 2.5 rupees, a level which is even broken the variable thermal power cost barrier for many stations, that is something which is very, very, very doable. And then when you look at it from a larger perspective, see, the cost of power has to continue to come down. So that is, as far as we know, the technology, what has happened to data, the fate of power tariff is going to be the same, and the costs are going to be much, much lower. As Masa said yesterday when I was listening to him in a SoftBank session on electricity, he said that after 25 years PPA tenure, the power should be available from that generation to the common people free of cost. It looked very, very radical to quite a few of us, but that could be the norm tomorrow. When an investor has recovered entire equity, entire debt in a 25-year tenure, the power generated from that station after 25 years, if it is made available for free or almost free, because there will be some operation maintenance cost, there will be some cost. That is something which, let's see, it has just been spoken by Masa yesterday, and we know that he is a visionary, how it turns out after the next couple of years. Now, if you talk about what our Prime Minister said, one world, one sun, and one grid. See, as of now, the international trading of power is very, very minuscule as compared to the consumption. And if you compare with any other commodities, the international trading in power is happening is almost negligible. And there is no unsolvable technological constraint that we have to make one world, one grid. And if that happens, of course it requires political will for which the momentum need to be created. Of course it has to pass the test of commercial viability, which as of now, whatever you are talking about, not factoring the negative cost of carbon-led generating stations that is impacting all of us. Now, if it happens, just think whether it is India or all ISA countries, the kind of opportunity this throws. The solar-rich, energy-poor, the solar-rich, GDP-poor countries, if they get one world, one grid, probably they all become exporter of sustainable, clean energy to the world, and that is uplifting overall health of all such economies as well as our planet. Now, coming back to the situation of banks and how bank has been looking at this sector. Now, banks are great in underwriting project finance, right? So they are very good in assessing the project risk. The local banks, they know the situation on the ground very well. They can ascertain the risk. They can put a suitable risk mitigant in place. Our government has been very, very progressive in mitigating, in helping banks and industry to mitigate all the key risks. I remember initially when we were discussing and the tariff used to be 17 rupees 91 paisa, and when the government used to ask, how do we bring down the tariff? There was a very, very coherent response from all the investors, whether it is debt investor or equity investor, that you please bring down the risk level. The highest risk was around land acquisition, and the government came out with solar parks. And that gave a lot of comfort, especially to the international developers. Okay, they don't have to get their hands dirty by land acquisition, by getting all those transmission and other approvals and clearance in place. And then we see a flood of all large global players to come and invest in our country. The same can be replicated across all ISA member countries. Then the other bigger risk was the payment risk. The financial health of DISCOM is not something that gives a lot of investors, whether it is equity or debt, a reasonable level of comfort. While there has been not a single incident, despite their poor financial health, of a default under PPA. When we say a poor health of DISCOM, of course they have not been able to honor their debt obligations. They have been defaulted and they have been bailed out by government in multiple ways. But when it comes to honoring their payments under PPA, they have paid. Of course, there have been gaps because they are dependent on budgetary support. Those support doesn't come on time. But just to cut it short, of course, the foreign investor didn't took it as lightly or as comfortably as we would have wished them. So the government offered NTPC balance sheet. NTPC, a AAA rated institution, the highest credible institution in our country, that balance sheet was offered as a counterparty. Of course, NTPC cannot take all the PPA risk. Therefore, institution, Solar Energy Corporation of India, SECI, was developed. And with the tripartite, there was a proper payment security risk mechanism put in place. There was a proper capitalization that was being done. And with that off-taker, we again see a lot of interest by investors. And thanks when you move with a lot of conviction, even the God supports. So the falling module prices, a lot of other positive developments that happened could actually help us bring down to a tariff which is very, very sustainable. Now, as a bank, whatever we may look at the sector, but the fact remains that the kind of scale up in the capacity that we're talking about, one IFC study was talking about a $5 billion investment required in the sector. Now that money cannot come from a banking sector. Now banks, as I said, banks are great in underwriting the project risk. But once project is standing on its own feet, then there is no point for example, it's a 25-year PPA, and suppose you talk about a 20-year kind of loan. For first 1.5, 2 years, till project stabilizes, it's all the reason why someone who knows the project as a partner should actually be supporting. After that, actually, banks should be taken out, and Mike suggested quite a few options, quite a few mechanisms which are established globally, which can help bank get out of those projects, release the capital, and then help in building new greenfield projects. I'll also like to add here that this, on this particular renewable energy, the kind of structure we have a very, very credible off-taker. There is no supply risk as long as the sun continues to shine. There is no supply risk. There is no demand risk as long as we believe that the PPAs will be honored and the kind of credible off-taker we have. And we have to believe that PPA will be honored, otherwise this sector will, of course, there is no point in discussing. If that happens, it can actually create a very vibrant bond market. The bond market one of the reasons why bond market doesn't exist in a country, in a developing countries to a level where we wish, because there is not very credible projects. If you get a very credible projects, having a very fair degree of certainty in terms of cash flows, you can have a very strong pipeline of bonds. Now, I believe that renewable energy project, the stage to which it has come to India, and with a lot of effort by all our ISA member countries, it can come to that level across globe. If that happens, it can help developing a very vibrant bond market. There will be investors who are looking for annuity returns, and of course, we know that there are a lot of low-cost funding institutions exist in the name of whether it is pension funds, whether it is insurance funds. There are a lot of retailer funds who want to invest, and they also would have some softer corner when they have to invest in a clean energy or a sustainable investment project. So with these words, actually, I would like to share my perspective. I would like to conclude my perspective on this sector, and I'm happy to address any question that comes along. Thank you, ma'am.
Mr. Agarwal has very passionately put forth the case for renewable, and I can see why he's been made global head of renewable energy at Yes Bank, because with those kinds of conviction, I'm sure he's been doing a great job with those who approach the banks for financing. Before I end with Mr. Kohli, with Mr. Popley, I thought I'll ask Mr. Ajit Agarwal. He's Director Finance of Rural Electrification Corporation. I started with the PFC and I thought I'll end with REC. You have heard the challenges that PFC narrated. You have heard the responses from very many of the panelists, including the panelists who have come from abroad and have shared their experiences in far-off areas, starting from Mexico to Taiwan. And of course, the multilateral agencies who have done things in respect of very many countries. Plus, you have also heard the two bankers from Citi and Yes. So given all of this, how do you feel what does the future portend, and where would you like to see government action to ensure that we reach the renewable goals?
Thank you, madam, and good morning to all of you. My fellow speakers have covered almost all the issues pertaining to the renewable sector, and there is nothing much to add on that. REC, as everybody knows, is a financial institution, has a role to play as a development of the power sector per se. The renewable sector, if you look at it, offers the best opportunity as far as the financing part is concerned, and you have no issues in terms of PPA. You don't have any issues in reference to the FSA. And the construction risk are the least, that the project gets completed in 6 months to 9 months at the most of 1 year. So whatever we have seen in the past in terms of the thermal power project, those kind of risks in terms of construction, in terms of FSA, in terms of PPA is not witnessed as far as the renewable sector is concerned. Now, as a banker, what we are concerned with the bankability of each of the projects which is getting financed from the banker's perspective. And you must appreciate the fact that the bankers, other than the regulators which controls the industry, just to some of the other things, I just come to that, every industry which has to prosper has to consider all the stakeholders' interest. Unless otherwise that is taken care of, the progress on the sector may not be seen as we have been discussing all along. Renewable sector stakeholders are who? The first of all is a developer, which continues to take a risk in terms of coming to a new area. Then you have a regulator which is controls the industry per se. Then you have the supplier of the equipments. Then you have a banker, and then you have a regulator. As a banker, you are controlled by two regulators in the terms of the industry regulator. And then you have a RBI, which is a financial regulator. Both the regulators might be seeing the things differently in perspective when you look at the financing of an instrument. All the issues which have been raised in terms of the resource assessment, in terms of the evacuation risk in the grid connectivity, the falling tariffs for per se, are known to everybody, and the solutions are almost known. One of the suggestions put forward by one of the fellow speakers is that the DSR, debt service coverage ratio, is one of the most important part. I think we as a banker would like to subscribe to that particular idea, that once you start bidding it out, whatever tariffs you have done your own homework, you know how you are going to implement and the project. If the DSCR, which is a vital part for any financial, is to do to see whether the project on a sustainable basis. You may have those kinds of financial products to start with 3 to 5 years, but what we are looking at, we are looking on a sustainable repayment of or service obligations of any of the funding agencies. There, the DSCR acquires a lot of importance. So my suggestion would be, since I have seen that we have been negotiating, that we have raised a lot of the green bonds, we have been negotiating line of credit with KFW. We as a banker do not find any dearth of equity or a low cost debt on a long-term basis. We do provide funding at 10 to 15 years, and we have been providing funding at a very low cost. But that should not result into a tariff which is not sustainable in a long run. My whole simple advice to the developer would be, take into consideration all those stakeholders' interest, work out internally what is a sustainable tariff, and bid accordingly, and I don't find any reason why the bankers will not come forward to support you. What we have seen in times of this competitive age, people have taken some assumptions which do not found out to be correct at the later date. As one of my fellow colleagues in Yes Bank says, the tariffs are going to are falling for the panels. Now the Indian rupee parity with dollars has shown what we have seen in the past. Those kinds of benefits would be evaporated if you just banked on those kind of equations that the prices are falling. But once you come to the rupee dollar volatility, is all gone. So these kinds of assessment by the developer needs to be done. And secondly, what we have been discussing in the market, that the tariffs have been falling. We have also funded REC as a feed-in tariff projects when the capex was 17 crores. Today you have a capex of less than 3 to 4 crores per megawatt. So tariffs are going to fall. Once you have been supporting a tariff at 17 crores per megawatt, and the tariff was feed-in tariff 16 rupees to 11 rupees, when you can set up a project in less than 3 to 4 crores per megawatt, so tariff on a pro rata basis is going to fall. I am not denying the tariffs will not fall. But every tariff which we have been discussing in terms of 2 rupees 44 paisa, the regulator has to make an awareness program what are the benefits attached to a particular tariff being quoted. Whether the land availability is making available to the developer, whether evacuation facilities are being made available to us. But as a general thing, if you look at it, the tariffs are going to 2 rupees 44 paisa, 2 rupees 50 paisa, would be a kind of disinformation campaign in the market. So my idea would be, our advice to all those developers, being REC, PFC, NIREDA, being a 3 government-owned agencies, we owe a responsibility for the development of power sector, and we committed to the same, would be that you do a little bit of homework.